So what we'll talk about in today's video is how you can fix a bad whole life insurance policy. Now, what I mean when I say a bad whole life insurance policy is that you got a whole life insurance policy, you expressed upfront that the reason you're putting money into this whole life insurance policy is because of the cash value. That is what you're interested in. You wanted to have as much cash value as possible from start to finish. And then after starting the policy, you learned that it was not set up for cash value. You could have had a lot more. Now you have buyer's remorse. You're thinking about canceling the policy. Before you do that, we'll go through some steps you can take to fix the policy. How we'll explain how you can fix the policy is by using an actual case study of a doctor that we've been working with for over the past year now. And full transparency, he hasn't bought anything from us. He reached out more than a year ago and said, hey, I've got this whole life insurance policy. I got it for cash value. I don't think it was set up right. Can you give me some guidance? And in just looking at it, we saw that before just canceling it and saying, hey, get a new one, this was set up wrong. Now, there are some steps he could take in order to salvage what he has already, which gives him a lot more money. Because if he starts a new policy, you've got to go through the new expenses again. Like, I wouldn't recommend doing that. So we'll go through the steps we took, things we did with his policy last year, things we're doing with it right now, and then also a secondary policy that he's looking at that is pretty cool when you look at what he's doing from a funding level and the flexibility, but we'll hit on that at the end. So why he initially bought life insurance. He was interested in the cash value. It's a safe, liquid, tax-free area to put money. Talking about the safety, he could grow his money without risk. When we look at the liquidity, he could use the cash value if needed. He's got a specific interest in using it for real estate potentially down the road. And then the tax benefits. So if you do everything right with a life insurance policy, you can access the cash value tax-free. What he is very attracted to is just growing the cash value and then long-term being able to take tax-free income during retirement. And just a little bit of context, he started this policy at 27 years old. So he started very young. His income is about to really jump now that he is a full-time physician. So he can do a lot more now than what he could do when he got this policy. But with that said, he knew that his income was going to be high and he was going to pay a lot of taxes. So the tax-free income during retirement was very appealing to him. Okay. The original setup of his policy, he got what is called a whole life 65 policy. What that means is that the premiums are contractually due until he is 65 years old. Question for you. When you hear me say the premiums are contractually due until you're 65 years old, does that make you think that you have to pay the premium until you're 65 years old? If your answer is yes, that's what I would say. It's not the case. Did you know you can actually fund a whole life 65 policy for 2 or 3 years and then stop altogether? Like pay zero and still see it grow if it's set up properly. We'll look at examples of different funding periods as we get into the numbers. But the policy that he set up, again, this is the original setup here. He just bought a life insurance policy. That's what he was sold. The policy had a base premium of $12,000 per year, and the death benefit was $900,000. What that base premium means, it's just the cost of the life insurance policy, meaning if you went and bought this same $900,000 life insurance policy at age 27, when this product was available back in 2021, it would cost you $12,000 per year. So he just bought a life insurance policy, like how he could buy a term and it might cost him $1,200 per year or less than that. But he bought a whole life insurance product. So let's take a look at how it performed. And we're going to look at the annual statements for the first and second year. And what I'll say about this is he got a policy with one of the 4 major mutual companies, Northwestern Mutual. The other 3 are Mass Mutual, Guardian, and New York Life. About Northwestern, they perform over time. Like, I have seen Northwestern Mutual be so consistent with the actual cash value performance, all of your 4 major mutual companies, especially when the policies are set up correctly. But you can't, Like, you can't knock Northwestern Mutual even when you have a policy that is not set up for optimal cash value. Once it's a couple of years old, I have a hard time recommending abandon ship by just canceling the policy, because it's a couple of years old, you're over the expenses, and I've seen them deliver. So if we just abandon ship and cancel the policy, we've got to eat the losses when I know it's going to perform over time. So before we ever cancel, we want to see what things look like short-term and long-term. We can ask for what's called an in-force illustration. You'll see some of those pretty soon, but we want to know everything up front, as opposed to just ripping the Band-Aid off, or I should say just canceling it and then finding out after the fact, oh, I could have done things differently and saved a lot of money. So he's got a whole life 65 policy. The start date was 2021. He paid 12 grand in the first year, and his cash value, $1,500. That was his first year cash value. Second year, he paid another $12,000. Here's his annual statement. His cash value, $3,700 and change. Where we can see that he's paying $12,000 per year, down here with a monthly premium, $1,000 per month. So that's what he's paying per month. That times 12 comes out to $12K. There's fees if you pay monthly, which I'm going to hit on in a little bit, just in terms of providing awareness. But he's paid about $12K per year. And by the second year, he's got $3,700. It's not that attractive, is it? No. Now, we met during policy year 3. So he reached out, I believe it was in 2023, and said, hey, I've got this policy. I don't think it was set up for high cash value. What are some options? Can you help me with this, or tell me if I should just get rid of it altogether? I'm like, I wouldn't get rid of it, just because you can usually make changes with an existing policy. All right, so here's what we did. We kept the death benefit around $900,000. How we did this, here's the important piece. And if you have a whole life insurance policy, this is the kind of stuff I would ask your agent. We reduced the whole life death benefit to $75,000, and then added a term insurance rider of $825,000. I should rephrase. We said this is what needs to be done. We drafted an email for him that he could just forward to the insurance company, because Northwestern Mutual is a company that does not work with independent brokers. So we couldn't get in there and actually do it. At the same time, he's busy. He doesn't have to try and think of how to articulate something that he doesn't work in every day. So we're like, we'll draft it in insurance language. We'll send it to you. You can make tweaks, but just keep the context here. Send it to your agent or the insurance company. And these are the changes that they'll make. Forward the changes to us first, so we can just make sure it was set up right. And then we helped him with that. So again, what we did, kept the life insurance the same, and then just adjusted the whole policy, the underlying policy. Because initially, he had a $900,000 death benefit, which costed him $12,000 per year. Keep that in mind. By making this change, whole life death benefit, $75K, and reducing the term rider to $825, here's what you get. His premium that was $12,000 is now less than $3,600 per year. And that includes the whole life death benefit and the term rider. So it includes the base premium plus the term insurance rider. He wanted to stuff this policy with cash value. He wanted to know the max he could put in. So on top of that $3,600, he adds another $20,000 per year into his PUA rider. PUA stands for paid up additions. This is how we accelerate the cash value growth of a life insurance policy. So we wanted to know how much he could add. So in the email we drafted for him, we asked that question. Like, we got to figure out the details before we make a move to make sure it's done right. Otherwise, you can mess it all up. So his premium, $35.48. PUA, $20,150. Comes out to a net of almost $23,700 per year. That's what he wants to pay into the policy. Okay. He's paying monthly. If you pay monthly on a life insurance policy, there is a fee assessed. The monthly premium, his actual out-of-pocket, comes out to $20,045. $20,045 times 12 comes out to $24,542. Meaning what he actually paid is that amount. That's what came out of his bank account. What was credited to the policy was that outlay we saw in blue, $23,698. So there's a yearly fee that comes out to $844. Whenever we pay into a life insurance policy monthly or any other frequency other than yearly, the company hits us with a fee. So here's the exact fee schedule. All companies will disclose this. Here's the total amount, $23,698, and then there's the monthly premium. If you multiply that by 12, you come up with a $24,000 and change figure. So we do get hit with a fee if we decide to pay it monthly, which he did know that. We just want to make sure that everything is crystal clear. So the adjustment we made last year when he reached out to us, just a high-level summary. First, we lowered the minimum premium from $12,000 to about $3,600. We kept the death benefit the same at $900,000. So if the life insurance is important to him, he doesn't have any change there, and he is married. So the death benefit is important. Also, being a doctor, student loans are high, especially at a young age. Here's something different he did. Instead of paying $12,000 per year, he paid $24,500 per year. However, the priority is now cash value. Remember the first 2 years of the policy? He paid almost $24,000. What do you have to show for it? It's like $3,500 or something like that. Not that much at all. So the end result of last year's change, he has the same amount of life insurance, but a lot more cash value. And he would have more cash value even if he continued to pay $12,000. But he gets the cash value, or I should say he sees the benefits of the cash value and he wants more of it. So he said, how much can I pay into this policy? And he pumped it with cash. Let's look at the most recent annual statement, which will reflect these changes. And I want to hit on something here. Here's something cool that a lot of people aren't aware of. With policy changes, if we make an adjustment like this, where we lower the premium and maximize the PUA rider, depends on the company. However, a lot of times you can make the effective date the policy start date. What does that mean? He started the policy in 2021. With the policy change, it assumes that we've been adding PUAs since day one, meaning we should see a bump in the cash value performance. Will we see it? Well, let's take a look. All right. I like this stuff a lot. It's fun. Okay, so here we go. Accumulated value, $30,000 and change. What was he at? Do you remember? At the end of year 2, like $3,700 or something like that. Now he's at $30,000, meaning it grew by about $26,000 or $27,000. Accumulated value, $30,000. There's the monthly premium. There's the yearly amount, about $24,000. But it grew by about $27,000. It grew by more than what he paid into the policy. The reason why is because that change went back to 2021 and it credited some more money to the cash value. Now, with that said, some companies do hit you with a fee for that. What we like to look at is, do we still come out net positive in a case like this? And in his situation, just full disclosure, like this is a bit of a long process. And the reason why is we're communicating to him what he needs to communicate with the insurance company and the agent. So we'll type that out for him, send it to him. This way he can say, okay, it makes sense. I'm going to forward it to the company. When he gets back from them, he sends it to us. And then we work with him to make sure everything looks good and say, okay, you can check the boxes and execute the change. And then he ultimately sees more money in his policy. But it does take some time, just some some upfront transparency on that when you're working with a company that doesn't work with brokers, or if you want to maintain the relationship with your current agent. Okay, so 2024 policy review. He recently reached out again, and he's reviewing the policy performance with the new dollar amount that he's paying in every year. And he's looking at it and saying, hey, this is just not performing. Even with the changes, like I get what we're doing. I get the cash value. It's taken me like 10 years to break even. And what that means when I say break even, that's when you get your money back, meaning you're running a loss up until that point in time. That's too long. I would not recommend doing that at all if you're interested in whole life insurance for cash value. We usually recommend breaking even between 3 to 5 years, sometimes 3 to 6 years, depending on the company and product and such. But you got to maximize the cash value to get out of the gates fast, and then you end up with more cash value long term, especially on a guaranteed basis. So, with that said, not happy. However, flip positions, what would we do? We would not recommend canceling the policy. Big reason why. He's with a major mutual company. I've seen them perform over time. Like I've seen it consistently from them. And they provide documentation that they actually perform. We get that from the other major mutuals too. That's one reason why I'd have a hard time canceling it. The other reason why, it's an older product that was started in 2021. The guaranteed cash value interest rate is 4%. That don't exist anymore. Now, his money's not growing by 4%. Anytime you see an interest rate with a life insurance policy, always be aware that that is not what your money is growing by, ever. The insurance company says, here's our interest rate. What they don't say is, this is a gross rate that will be applied to your policy after the cost of insurance and such. Unfortunately, they don't say that. But with that said, the minimum floor is 4%, and today that doesn't exist, meaning this will have stronger guarantees than other life insurance policies that he looks at. So it is worth keeping, or at least considering keeping that policy. I'd have a hard time saying, let's just get rid of it. So the question really comes down to this. How do I stop the pain, but keep the long-term benefits? I'm sick of seeing it take forever to get my money back. Like, how do I get rid of the pain, but still get the benefits here? Is that possible? The answer is yes, it is. All right. So here's what we requested from Northwestern Mutual. Took a lot of back and forth. There's still back and forth because we haven't got all of the options yet. But here's what we want to see. What does my policy look like if A, I just keep doing what I'm doing? I keep paying the same $24,000 per year up until age 65 because that was the original plan. We'll look at that illustration. B, if I keep paying that same dollar amount, but I stop after the 10th year. Right now he's in policy year 4, so he's got some time to still do that if he wants to. C, what does it look like if I reduce my premium just to the minimum, which comes out actually to about $3,200 per year? You could drop it that low. So the base premium is reduced, but what option C is stating is I want to reduce my cash flow to $3,200 per year right now. I do not want to keep on paying $24,000 per year because I don't like the way this is performing. If he expresses that, this is a nice option to consider. This stops the pain, but lets him keep the long-term benefits. You'll see exactly what I mean. Now, what he can also do is he can pay this $3,200 through the 7th year. And beginning year 8, we can exercise what's called a reduced paid up option, an RPU, which eliminates the premium altogether. Therefore, it's not even due. He can't pay it even if he wants to. But with it gone now, all dividends and interest are just kicked back into the cash value, and it keeps on compounding, which is sweet. I like that option a lot as far as an option to be aware of. And then option D, 0 out of pocket right now. So what you could do here is elect the dividends and interest to pay the premium for you, or for him in this case. So he could say, I don't want to pay it. In this case, I would reduce it to the minimum. Then I would have the dividends and interest pay it. This gives him a zero out of pocket now. So this stops all pain from a cash flow perspective going into the policy. And then in year 8, I would exercise that reduced paid up, which is a nice thing to be aware of. Want to look at some examples? All right. So let's look at the illustrations, and then we'll look at it on Excel. This will be interesting. So first, we'll look at one of the illustrations where he pays forever. You might have noticed on the options for option A, in parentheses, we had that term MEC disclosure. MEC stands for Modified Endowment Contract, which we see up here. What are the benefits of a life insurance policy regarding the cash value? Do you remember the reasons why he bought this? Safe place to put money. He could access it. It was liquid. It was also tax-free. The third one. The tax-free piece. A life insurance policy becomes a modified endowment contract. It works more like a 401k. We cannot deduct payments. But what happens with a modified endowment contract or a MEC is the cash value grows tax deferred. And if you ever want to access it, whether it's through loans or income during retirement, with respect to the gains only, you have to pay a 10% penalty tax and also income tax on the gains. It ruins the tax-free benefit. Like, we don't really want that. So we want to prevent it. Okay. So with this policy, in 2033, which is beyond policy year 10, because up here he's starting in policy year 4, it would MEC if he continues to pay this much forever. And this funding schedule continues through age 65. We've got guaranteed scale and then current scale, which is based on the current dividend rate. The accumulated value represents his cash value growth over time. Okay, let's take a look at this. So what we've got here is as follows. First and foremost, what we just looked at. What I want to highlight is the first 3 years. This is what has already happened. He paid in 11,902. He paid in 11,902 in year 2. In year 3, he paid in 21,441. Why it's an oddball number is because we made that change during policy year 3. It wasn't at the beginning. So that was the net dollar amount he paid in. We see a nice cash value jump. He got back more than what he paid in. And the main reason why is because of that change, and he got some money credited back to cash value, going back to that point. So 2033 is when he would be 40 years old. That's when it would MEC. So if he says, hey, looks good if I pay forever, but I don't want it to become a modified endowment contract, what are some options here? Well, we can stop after 10 years. So first, we've got the first 3 years. Then you've got the exact same scenario, about $24K per year, through the 10th year. And then what happens? 0. So we stopped his payments altogether. And what do you notice here? He pays 0, but the cash value continues to grow. Growing by 10 grand per year, continues to compound, gets better and better. So it does grow over time, but let me ask this. If you look at either of these illustrations, when does he get his money back? I'll give you a hint. Look at the total outlay column. What do you see here? By the 9th year, he's paid 187. He's got 186 in cash value. That means you have not broken even. By the 10th year, he's paid in 211,000. And he's got about 217. He has broken even. Same thing happens over here in this example. That's the first year's cash positive. Remember when he said, it's taken too long to get my money back. 10 years, like I don't want to do this. This is exactly why right here. Okay, let's look at the next set of illustrations. We're going to look at here is reduction amount. So this is option C. So we said that the premium is reduced to what? $3,100 and change. This shows $3,306. Why? Go down to this. He's paying it monthly. If you multiply that by 12, comes out to the number we saw in the illustration. If he pays it yearly, there you go. There's the $3,100 and change that is actually being paid into the policy, which is good to be aware of. So back to the illustration. This was the example where he wanted to reduce the pain right now, a reduced cash flow going into the policy. There's the cash value on the far right, and there's the death benefit. So let's take a look at this on Excel. We'll do the same thing we just did. Sheet 2. There's the first 3 years. He's in year 4 right now. So we're assuming we make this adjustment through the policy year. He's got 3 months left or 2.5 months left. So he would pay less as far as the total yearly amount in year 4. And then we see the full effect of the adjustment beginning next year, where it's about $3,200 per year. And I would recommend flipping this to annually too, if it doesn't bother him. So here we've got funding through policy year 8. And then after that, we've got that reduced paid up option. Now he can actually do a reduced paid up in year 8. This is the joy of being a middleman, going back and forth with someone that's trying to get answers from an insurance company. We're still working on the formal illustrations here. But my point is, this is close enough. He could stop this a year earlier than what's illustrated here. But what do you notice? Well, now he stops altogether. Cash value continues to grow. If we put a rate of return here, as far as what it's compounding by every year, it'll be almost the same as what we saw in the example where he max funded it at $24K per year. So reducing that now is not going to negatively impact him too much because he's already got a decent amount of money in the policy, which is nice to be aware of. And then option D, we don't have from the insurance company yet. We do want to assume he stops payments altogether. This is what we were provided, but the problem with this is they exercised reduced paid up in the 5th year. Reduced paid up is when we eliminate the premium, and that triggers a MEC. We want to wait until the 8th year to do that. So we're still working with them on getting that illustration. But he's leaning toward this, option C, because he's also kind of at the point where he says, hey, that $3,200 does not bother me that much just based on my cash flow right now. And I want to get this thing done with and behind me. Like I can already salvage the performance by doing this. So let's look to move forward on this, which we'll probably do. But we'll still look at some other options in the meantime because it is his money that we're dealing with. Again, we don't want to make a mistake and then find out after the fact there's a different option or something different we could have done. So that's what we did to correct the policy. To wrap this up, we're going to look at one option that he wants to look at after this is fixed. Here we go. So he wants a policy where he can fund up to $200,000 per year, but he does not want to be committed to or locked into $200,000 per year. He only wants to be committed to about 10% of that, which is $20,000 per year. This is what we like to call a 10/90 split, meaning I want the ability to pay up to $200K per year, but I only want to be committed to 10% of that, $20K. So 10% goes to the premium, 90% goes to PUAs. PUAs give you more cash value. Premium gives you more death benefit and less cash value. Make sense? Cool. All right. The end is here for the last illustration. What we've got is as follows. Minimum premium, $20K. PUA rider, $180,000. PUA rider, do you think you have to pay that? You don't. It's optional, meaning he can literally commit just to this and then add this at his discretion. Add the two up though, you're at 200K. Annual funding is what he pays every year. Total funding is the total out of pocket. That's going to add up all of the yearly payments or all of the annual funding. Then the cash value. That's what he's interested in. What do you notice there? Pays in 200. It's got about 177 right out of the gates. Close to 90%. 90% would be 180. Then you've got funding for 5 years. That's a total of what? 200 times 5 equals $1 million. What's highlighted in yellow is his break-even point. Almost year 4. Almost year 3. Year 4, he's cash positive. So year 6, he pays 0. Year 7, he pays 0. He pays 0 indefinitely after that. And the cash value keeps on growing. And then you've got the death benefit there too. So high initially at $5.3 million because that's how much he needs in order to be able to pay in $200K per year without triggering a MEC or a taxable event. That's option A. Here's the cash value growth. First year is the worst year. Best year is every year after the first year, where the compounding just gets better and better. But we always like to highlight that. Like the first year, we take a loss. We don't have positive cash value growth. And it's important to highlight that. This has been an area of confusion for a lot of folks for a long time, where they think that they're putting money into a policy, getting a dividend rate, and they've got a positive rate right away. Like that's not how it works. Like I want it to be transparent to see what am I actually getting year over year. Highlight the drawback. Understand that I'm losing money in the first year. Am I still comfortable with it after the fact when I look at everything else that comes with it? The fact that I can loan against it. It keeps on earning interest. I've got the tax-free benefit. It's very flexible. A lot of times people like to use it for real estate transactions. They don't have to work with an actual bank because it's quick. There's a lot of benefits, but I've got to be comfortable with the drawbacks. If I know them up front, I can make an informed decision. So that's option A. Option B is the same product, just with a different PUA rider. It's got a higher fee up front. And what that results in is the less cash value up front at the late break-even point, but more long-term potential. For example, when I look at the 20th year, I see more value there based on the non-guarantees. Regardless of which one he likes, my point is here, we like to show both and let him pick the one that he likes the most. If he says, I'm torn, I don't know what to do, you can split it down the middle or go 70-30. Like you can get more than one policy. As long as they're split up correctly from a ratio standpoint, we're going to see similar returns and cash value performance, all that good stuff. So with all of that said, I do hope that you enjoyed this video. I would love to hear your thoughts. And if you have any questions at all on the details around his policy, if you'd like to see anything different, if you've got a policy that you'd like us to examine and provide some feedback, we can certainly do that. It doesn't have to be on a video. We've been working with him for more than a year, and then I just thought this would be a cool case to document. But in any event, we'd love to hear your thoughts. Thank you so much for watching all the way through. And as always, I hope this helps. Thanks so much for watching.